the question is about my thoughts on value investing. So to learn more about value investing, read this book. This book is the reason that Warren Buffett is successful today. In fact, the writer of this book, Benjamin Graham, was a professor at Columbia University, and that's why Warren Buffett went to Columbia University. And this book will tell you everything you need to know about value investing. The bottom line is this: you want to value companies based on their assets, minus their liabilities, of course, as well. And a lot of value investors love to look at what's called the price-to-book ratio. The price-to-book ratio means the value of what Wall Street is valuing that company at, divided by all the stuff they own in their company minus debts. Okay, and lower is better. Lower is better, like PE, lower is better. And so the rule of thumb is a lot of value investors love to invest in companies that have a price-to-book ratio of less than 1 times. Less than 1 times. They also love cash flow. They love dividends. They don't like expensive companies. It's like religion when you talk about growth investors versus value investors. And I've done that in another vlog. You can go and look at it as well later if you want to, or during the replay, I'll put up the card here or image to check that out. But growth investors and value investors differ materially. Again, it's like religion. You're either a growth investor, meaning you like to buy expensive stuff like I do, that's growing fast, or you're a value investor. You like to buy cheap stuff like Mr. Buffett does, who's much better than I am. So the bottom line is look at price to book, read this book, and also value future cash flow. So learn how to do a DCF or discounted cash flow analysis if you're interested in being a value investor. And I teach you how to do that in 2 of my courses. One is called Introduction to Finance Accounting, Modeling and Valuation. And the other one is called the Complete Financial Analyst Training and Investing course. So if you have any more questions about value investing, please let me know. And usually it's interesting because I find that people in universities and students are more inclined to be value investors than people that are not in school. And the reason is because in university, when you learn finance, you're taught buy cheap stuff, buy companies with low multiples. And then you get out in the real world and you realize that's not the way the world works. There's different classes of investors, not just value, but growth investors too. And growth investors love to value companies based on future earnings potential many years from now. And so a lot of rookie hedge fund analysts will start their careers by saying, hey, let's short Amazon because it's expensive. Let's short Netflix because it's expensive. Let's short LinkedIn when it was public because it's expensive. And those are widowmakers because what happens is, sorry, that's a harsh term. Those are bad ideas because what happens is these companies are not expensive to growth investors because growth investors value those companies based on earnings in 5 or 10 years. And so, for example, when I used to own a lot of LinkedIn, when it was publicly traded, people would always, and when I used to own a ton of NetSuite, when it was publicly traded, people would always ask me, don't you think you're a little bit crazy owning that stock because it's so expensive? And they miss the point. The point is that no, it's not 100 times earnings in my mind, right? They look at 100 times earnings this year, for example. In my mind, it's actually only 3 times earnings in 5 years. That's a bargain. That's a bargain. So everyone's got a different philosophy. And you always have to think about what kind of stocks people are going to want to buy. And Tony, I know you're on this call. I have to mention Wayne Gretzky, best hockey player ever, obviously. Gretzky was very successful because he said, I used to skate not to where the puck is, but I had the foresight to skate to where the puck is going to be. By the same token, I want you all to invest in stocks or any companies for that matter that people are going to like. And when it comes to growth investing, which is what I am, I'm a growth investor. I love buying stocks in companies that people are going to like. How do I do that? Well, I model, 5, 10 years into the future. Let me show you an example, actually, let me see if I can show it to you in real time here. So I'm going to download this with you in real time. So all you do is you go to my website, okay, and you go to harounventures.com/template. And then you click on here to download the template with technicals. If you're very long-term focused, I suggest down in this one here that doesn't have technicals. I just wanted to create a menu for everybody. Then let's click here on a sample report I wrote on NetSuite. And then one on eBay we'll look at in a second. So on NetSuite, I completed the template, and this was back in 2011 when I ran my hedge fund. And the company was only a $2 billion market cap company. And a lot of people thought I was crazy because the valuation was egregious. So if you look at the valuation down here in my model I made, this is just an excerpt from my model. I teach you how to create models in my course, the Complete Financial Analyst training course. But here you can see the PE ratio is over 200 times. However, if you look at the earnings way out here up until 2020 or so, it basically the stock was trading at 3 times my 2020 estimates. And so I always look longer term. I always invest in companies that people are going to like. I always ask myself, in 5 or 10 years, is this company going to be more relevant or less relevant than it is today? And of course, this is a cloud computing company that's similar to SAP, but all cloud-based. So yes, of course, 5 years from now, at that time, cloud computing is going to be more relevant than it is today. That was my thesis. And so you can see here that I had that the valuation was dirt cheap. And I based my price target on that as well. And so my price target at that time was a 24 times PE multiple. I wrote here you have 800% upside over the next 10 years to a target price at 220. And so I did really well in this investment, but a lot of people thought I was crazy buying it because it was so expensive. And what they're missing the point. If you're longer term focused, it's cheap. And again, I'm a growth investor as opposed to being a value investor. I respect value investors. I used to be a value investor when I was at Columbia, which is actually the same university that Buffett went to. And Buffett actually, he came when I was at Columbia doing my MBA. He came and lectured one of our classes. And this was in 1999. And he showed up with his wife. And his wife joked at the time that he brought this book on his honeymoon, which is true, he did. That's how passionate he is about investing. He doesn't have a job, he has a passion. And I remember at that time, a guy in my class started pitching a stock to him. And about 30 or 40 seconds into the pitch, Warren Buffett, very grandfatherly, interrupted in a nice way and said, "Son, I'm going to stop you there because I don't know where that company is going to be, that technology company, in 3, 5, 10 years." He just didn't understand it. He wasn't passionate about that sector. And the difference there was that the person that asked that question was a growth investor, and Mr. Buffett was a value investor. Okay, so you can look at this in more detail if you're curious on my thought process on NetSuite, but the bottom line is this. Eventually, Oracle bought the company a couple years ago, and if you look here, you see that 79% of revenue for NetSuite at that time in 2011 was in the United States, and 21% was international. And what happens is quite often large technology companies like Oracle, Microsoft, and Hewlett-Packard, they'll buy smaller tech companies that are mainly US focused with respect to their revenues. And right away, that deal can be accretive, meaning it can help earnings more than you think. Because those 3 aforementioned big companies, and any big tech company, has more than 50% of revenue usually overseas. And so what they can do is they can send the product NetSuite. When Oracle bought NetSuite, Oracle could sell NetSuite's products through all of its distribution channels all over the world, whereas NetSuite, per this report that I wrote here, had 79% of its revenue in the United States. And so that deal becomes accretive much faster than you think it does. Now, just to be intellectually honest, I showed you a write-up I did here on a growth company. I want to show you one I did on a value company as well. And so if we go back, let me just check if Wrigley is sending me texts. Okay, no texts. That means it's good. Wrigley, why do I only hear from you when there's problems? I'm just kidding. All right, so if we go back here, I want to show you a sample report on eBay, which at that time was a bit more of a value investment for me. And you can see that I wrote this back in 2009 when I ran my hedge fund, and America was on sale. Okay, the stocks were really, really cheap then. And it was scary, though, because 1 year before that, in the fall of 2008, we were within 24 hours of bank machines not working. It was frightening. It was frightening. And so you'll see here, if you want, you can read through my write-up here. I talk a lot about fundamentals. I do talk about technicals as well. just in this one report because the market was incredibly volatile at the time. I saw the downside in eBay at that time to $22, and the upside was 29 at that time. Not that much upside. But if you're curious about the technicals, I wrote that because of technical support, and you can read through this if you'd like to. Then I talk about the valuation here as well. And at that time, and I wrote a more recent version of this as well, you know, eBay had two big parts to it. The sleepy eBay core auction business called Marketplace, which value investors like because it's slow growth and decent cash flow visibility as well. The other side of it was the growth side, which was PayPal. And growth investors only wanted to own eBay because of PayPal. And so what happened was a man named Carl Icahn, who's a private equity investor, he's an activist investor. And what he did was he bought a lot of eBay and he put himself on the board. If you buy a lot of stock in a company, you're allowed to join the board. And what he did was he convinced the management team to break the company into two pieces to unlock shareholder value. PayPal, which the growth investors loved, and core eBay, which the value investors love. And core eBay was just the marketplace auction business. And that unlocked shareholder value because these two independent companies were worth much more than eBay alone as it was before the breakup. And if you're curious about this transaction, want to learn more about this in detail, I created a vlog that discusses this. And you could search my vlog, or if you're watching the replay of this, I'll put the graphic up here as well. So if you have any follow-on questions about that, please let me know.